Hello, everyone. We wanted to get something out for 2023. We haven't done a video update in a few months now, and I feel like we're at a good point to recap some of 2022 and then also get into where we've started off here in 2023 on a better note. When we look back at last year, it was pretty clear when we started 2022. We were coming off the back of some pretty good years in 2020 and 2021 for most investment portfolios, and we started to see some stress. And especially in the summer, June and July of 2022, inflation was really heating up. A lot of discussions about how high was inflation going to go, how high were interest rates going to go, and what type of damage would that do. So I shared some charts last year in September and October, and this is one of those charts. And at that time, we were sitting in the summer and kind of wondering what that path forward was going to be. There was an optimistic scenario that we just push right back out of it and get back to all-time highs. But there was also a mild recession scenario, and this is more or less uh, an aggregate or an average of what a lot of the forecasters think, which sometimes we don't take too seriously. But looking back on it, this light brown mild recession scenario is pretty much what we've experienced so far. In October of last year, we hit some lows. So we saw more stress, not just in June, but in October. And then once we got through October, we've been grinding a little bit higher. And so this light brown is what we've been pretty close to. And this is what the actual stock market has done. Again, in June, we hit some lows, experienced a little bit more stress in October, and then we've been on this gradual recovery ever since then, with especially the last few months looking much better. And I also visited this chart last year, which looked at consumer confidence and trying to look at it as maybe a buying opportunity. So anytime the market comes under pressure, at some point or another, stocks are cheap, right? They become a good buying opportunity for people in the right position to do so. And when we looked at this extremely low consumer confidence level in the summer of last year, when people were a little panicky about inflation, when you look at those troughs or the lowest numbers, if you were to be a buyer in the market, there's a very good forward-looking growth rate, 24%, almost 25% typical growth in the following 12 months. So what ended up happening, right? We're not to September yet, but since then, since the day that September consumer confidence number came out, we're 23.79% up from that point. So it did have some predictive ability to buy in the midst of fear. It's really hard to do that, but that's why we bring up these points to kind of a contrarian point of view. Hey, this is what typically happens, and this is a scenario where it played out pretty close. We've got to get to September, right? We're a few months away here, but it looks it's trending in that direction. And then here's another chart. Keep dragging this around, that goes over when the stock market is down 25% or more, what's going to be the experience 1 year later, 3 years later, 5 years later. And at the time when I went over this in September, we weren't really September, October, I went over it. We weren't really sure, right? Hadn't been able to fill in that blank yet. But like I said, we hit the lows in October. We're up about 23% off that low point. And so it looks like this box is going to fill in green, with the stock market at its worst point last year being down 25.2%. And then over the following year, are we going to turn in a good number? It looks like it should, right? We've got to get to September, but again, it should. And so it should fill in some similar boxes. And when you look at the averages across these spectrums, average is okay. We'd be perfectly fine with average on some recoveries after a 25% drawdown. Um, so where are we? We've got a market that's recovering. It's pretty much on trend with what was maybe a mild recession scenario. A lot of the effects of rising interest rates, higher inflation, they didn't cause as much damage, or in some cases, any damage to the U.S. economy or to companies. It's been minimal impact considering how much we suffered in 2022 across all investment portfolios. There wasn't many places to hide or hold up. So it seems we're shaking that off. Now there's still some things we're dealing with. So what's happening? Well, we're at the moment we're kind of looking past some of the weaknesses. There are still some weaknesses out there, but the market is saying, "Hey, this might be temporary. It looks like it's temporary." Back in early 2022, when inflation was picking up, the Federal Reserve called inflation transitory, and it was kind of a joke at the time because it's how do you define transitory? Is it a few months worth of inflation? Well, now I think the market is digesting this as well. Maybe it's a few years worth of inflation, but it appears that maybe somewhat normal conditions are coming. Here's inflation. So, especially what you see in the news in purple, peaking out at over 8%, got 9% headline inflation. The Federal Reserve got really serious about rate hikes at that time. And ever since then, we've seen declining numbers. Again, this does mean that prices are still rising. It's just the rate of change is slowing, getting back down to more tolerable levels, but it has not reached its ideal level of 2 to 3% yet. It's still 4 to 5. So what did the Federal Reserve do to fight this? Well, they raised interest rates. Right, all the Federal Reserve can do is increase the shortest term rate, lending rates between banks. It's called the federal funds rate. And so you can see they rapidly increased this rate from practically zero all the way up to where it is now, up over 5%. So what's the expectation? Well, the Federal Reserve says, hey, we've still got some work to do. We're going to raise rates a few more times, and maybe they gradually come back down to target over the next 2 to 4 years. The market in green is under a different belief. They believe that they believe they're bluffing a little bit, and they believe the rates will go up once and then come down a little faster because inflation will be under control. So there's a difference, right? So we fall in the camp of actually a little bit more towards the Federal Reserve. There's a lot of strengths you can point to with the consumer, levels of spending. Well, I don't want to say strengths. There's a lot of confidence out there that is going to continue to keep inflation at above ideal levels, which I think the Federal Reserve will have to keep their foot on the gas, keep rates higher for longer than we anticipate. I don't want to say it's a new normal to have rates a little higher, but maybe, right? I think it's more possible than people think. So I think one thing to touch on is, again, what the Federal Reserve controls. They control the shortest term rates. So in blue, this is Treasury bonds and rates that the federal government issues for debt. The shortest rates, things that are at 3 month or maybe 1 year increments, are up at 5.5 to 5.4%. And then so for example, if you purchased a 2 year Treasury bond, it would be at 4.9% as of yesterday. Well, usually when you give someone else money for a long period of time, I mean, just think of it, logically. Hey, I'm going to give you money. You're going to pay me back a little bit of interest, but you don't have to pay me back the principal for 2, 3, 4, 5, 10 years. Usually when you wait longer, you're paid more for your patience. You're rewarded for that. But in this case, higher interest rates are kind of, artificially created, right? The Federal Reserve is pushing interest rates higher, and the market doesn't believe those interest rates are going to stay that high for longer than a couple of years. So longer term rates are reflective of inflation being normal one day or reasonable. And this is maybe reflective of what you see with CD rates. So if you go look at a very competitive CD rate for a 1-year CD, it's going to be at about 5.2%. Because what that bank is doing, they're able to purchase a treasury bond at 5.4%, and they're okay with giving you 5.2. They make a little profit spread, a little margin off of it, and they're happy, you're happy. And so you'll notice that with longer duration CDs, 2-year, 3-year, 5-year, that rates are much lower because they can't get the higher rates from treasury bonds. Gets back to the market recovering and seeing some things that are a little worrisome. So outstanding credit card debt, revolving consumer debt is on the rise. And you can see it from a couple different angles. One, credit card debt is increasing because people are trying to keep up, right? There's a lot of confidence. People want to travel. They want to get out. We had a couple years where that wasn't possible, and wasn't that long ago. So things like a savings rate, right? When we were going through the midst of COVID where you're locked down or you're not able to move as much, people were saving a lot. I mean, record levels of savings as a percentage of their income. And it's back down to a pretty low level, actually some of the lowest recorded levels on history. So there's two different ways to look at that. One is, oh no, that's not good. People need to save more. The other one is, well, maybe we're just kind of making up for some lopsided years. That's been a trend with COVID, is seeing these distortions in one direction or the other. And so the market is looking past this high credit card debt and this low savings rate because inflation is coming down at such a nice gradual pace. They're saying, okay, well, here soon the consumer might be able to get it under control, and here soon they might be able to save more. Another positive thing to look at would be just complete consumer debt. So this would count for auto loans, personal loans, credit card debt, and it looks at as a percentage of disposable income. It was very low during COVID, so student loans as well. So it's been increasing, right? People have been using credit more to try to keep up, but it's actually just as a percentage of household income, disposable income, it's actually at just a normal level that it's been at since post-financial crisis. So this is something that the market is pointing to as well, saying, well, hey, things are getting worse, but they're coming off such a position of strength that maybe it's not so bad. So let's look at the market. Right, where do we stand? The market is recovering. We're not back to all-time highs, but we're at a better level, looking at some decent performance on the year across most portfolios. This is what's called a price to earnings ratio. And to sum it up, it's just if you put $1 in the stock market today, what type of bang for your buck are you getting? Right? It's what's the price you pay for every earnings or every dollar of profit per share. When the line is up here, this gray line, for example, this is in the 90s and early 2000s, the dot-com bubble, you were paying nosebleed prices to buy into the stock market, right? You were having to pay up for these dot-com companies that didn't really have any profits. That didn't end well. For most of the mid-2000s, 2008 financial crisis, when the line is down here, that's a screaming buying opportunity for stocks. They're very cheap, and so buying even just a general index fund is usually a great strategy. But as we recovered from the financial crisis, we kind of hovered around the median, the average for a while. COVID sent us lopsided back up into the very expensive territory. And here recently, again, we hovered around the average, but we're back up to a little bit of an overvalued market. So if you're putting $1 in the stock market today, what can you expect? right? What is, are you getting a good bang for your buck? Not really. It's not the best company to be in. So this is a scatter plot, and it says, the market has been at this level many times throughout history. So when it's at this level and you look at the next 1 year worth of returns, what's the spread of outcomes, the good and bad? It's a little bit more randomized than you'd like it to be. It's almost not quite 50-50. Basically, you have some extremely good outcomes, and then you have a handful of bad, and then there's not much in between, because we're right on this red dot. When stocks are cheaper, you slide up into this territory where in any given year you have this complete, a higher probability of turning in a nice positive number. Here's the percentages on the left hand side, whereas we're a little bit in no man's land at the moment. The outcomes in the past have been, we continue euphoria. The market rolls on. It does really well. Companies keep pushing higher. And we worry about maybe we increase, profits recover and increase, and we work our way out of it. Or you take a step backwards. And on a 5-year basis, it's similar, right? If you put $1 in the stock market today and you said, hey, I'm going to check on it 5 years from now, what would you expect? Maybe a 5 to 6% average annual return. Now, this number moves pretty quickly. Okay, I mean, just a very short time ago, it was about a 16, which would slide you back into this range of having much higher average annual return expectations. So we're watching it very carefully, but it's a measure that you want to keep a close eye on in a diversified portfolio. When we look at our portfolios, let's drag this up here now. These are some examples, from a growth portfolio, balanced, conservative. We have more models and portfolios we manage, but these are some simple versions. And they're made up of stocks and bonds, or in this case, it's labeled as equity and fixed income. But there's a yellow category here that says flexible. So in any given investment model, we have about 10% that we can be more tactical with. We're believers in staying invested, and I'll show you in just a moment of why that is. But with that position, with that 10% of each portfolio, we can be more defensive, more aggressive, or neutral, somewhere in between. The reason why you stay invested, right? Whether you make that 10% sleeve more conservative or more aggressive, you stay invested because that's historically a winning formula. In any 1 month, there's a 63% chance that you're going to have positive returns. In any 1 year, there's an 80% chance, and so on and so forth. It just gets better. And this is basically international stocks in this column, World ex-US, and then the S&P 500. So no matter how smart we think we are, or what we think we know, when you decide to bet against the stock market, the odds are not in your favor. And that's proven itself time and time again. So it's best to stay invested and just lean away from risks or towards opportunities. That's where you can create an edge, knowing that you're never fully committing in either direction, which can lead to some big wins and losses. And this is about consistency. This is another way to look at it, which I've shared in the past, is if you were to miss some of the best days in the market. So this is dating from 2003 to 2022. If you were to miss some of the best days in the stock market, just a handful, miss the 10 best days, it cuts your average annual return in half. You go from a 9.8% average annual return to a 5.6% average annual return. And this is making the point that 6 of the 7 best days occurred right after the worst days. So just when you think, oh my goodness, the sky is falling, this was a terrible day in the stock market, the rebound is usually real close. And if you miss those rebound days, that's what can cut your average annual return in half. And so we know that, and we're not going to overcommit ourselves in either direction. But when the evidence starts to shift in a way of saying, you know what, on a short-term basis, long-term, we're buy and hold investors. Short-term, maybe there's some need for caution. So with that 10%, we're using a conservative allocation fund, very diverse, still has upside potential, but it's a shock absorber. I mean, that's the best way I know how to describe it. So for example, if you looked at this fund versus the US stock market during COVID drawdown, it held up much better, right? It's a very good shock absorber if you were to get a little pullback here in the stock market. Also, there was another pullback at the end of 2018. I remember this one well. It was just bad timing. I think the stock market was down 3.5% on Christmas Eve. So I remember the timing of it all. But this looks at what was a pretty significant little 1 or 2 month drawdown in the stock market at the end of 2018. And again, the conservative allocation fund held up really well. We've got this as a small piece in a holding pattern. We've taken advantage of some good performance so far this year. We're a little bit defensive at the moment. Short-term basis. If we do get a little volatility or some degree of a pullback, we don't want to have this in the portfolio technically. We want to be neutral or more aggressive when the opportunity presents itself, but that's what we're watching it carefully for. Hope you enjoyed this update. We've got another update coming out very soon on growth investing. And this is for any one of our clients that has even a small fraction of their portfolio that is aggressive growth, even if it's one account. This is going to be a great slideshow we go through on some changes we're making to those aggressive growth models and what that can lead to. So that's actually a lot of data, a lot of slides, but some good stuff to go through. So hope you enjoyed this. Let us know if you have any questions, and we're happy to assist.